Hi, I'm Lena, and welcome to Super Data JP, the channel where we turn Japan's real estate and cost of living numbers into answers you can actually use. Every video here is built on verified government data, not opinions, and not guesses. Whether you're planning to invest, relocate, or just curious what life in Japan really costs, you're in the right place. Let's get into today's numbers.
Apple Japan, Amazon Japan, and Google Japan are all registered as the exact same entity type as the cheapest, simplest company you can form in this country. That's not a coincidence, it's a specific tax move available to foreign owners, and most people setting up a Japan property company have never heard of it. This is the fourth video in our series on the tax, visa, and legal traps that actually decide whether a Japan-based investment works out. We've covered capital gains on selling property, inheritance tax for foreign residents, and the exit tax on your portfolio when you leave. This time, should you even buy Japanese real estate through a company in the first place, and if so, which kind? Search GK versus KK Japan, and you'll find endless comparisons. Almost none of them mention the most important fact: for tax purposes, the two are essentially identical. Same corporate tax rates, same consumption tax rules, same local taxes. Ajure Kaisha, a KK, Japan Standard Stock Company, costs roughly 250,000 yen to set up, registration tax of at least 150,000 yen plus articles of incorporation notarization. A Godo Kaisha, a GK, Japan's version of an LLC, costs roughly 100,000 yen, registration tax of at least 60,000 yen, and no notarization required at all. So the real difference isn't tax. It's setup cost, governance flexibility, and, for some investors, credibility with banks and tenants, where a KK's more established reputation can matter. Which raises the actual question this video answers. Forget GK versus KK for a moment. Should you buy property through a company at all, instead of just owning it personally? Own property personally, and rental profit gets taxed as regular income. Progressive rates up to 45% national income tax, plus roughly 10% local resident tax, a combined top rate near 55%. Own it through a small company instead, and you hit what tax professionals call the 8 million yen wall. Taxable income up to 8 million yen is taxed at an effective rate around 22%, and everything above that at around 33.5%. Run the numbers on a real scenario: an investor with 20 million yen a year in net rental profit, comparing personal ownership against a small holding company. Owned personally, that profit generates roughly 7,313,284 yen in combined income tax, surtax, and resident tax, about $45,144, an effective rate near 37%. Owned through a company, the same profit generates roughly 5,780,000 yen in corporate tax, about $35,679, an effective rate near 29%. Before you conclude a company always wins, there's a cost that applies only to companies, and it applies whether you make money or not. It's called kintouwari, a flat local inhabitant tax on companies. In Tokyo, a small company pays at least 70,000 yen a year, even in a loss year. An individual owner with zero profit pays zero tax. A company never does. There's a second fixed cost people miss: mandatory professional bookkeeping. A company's corporate tax filing is far more complex than an individual's rental income return, and a tax accountant for a small holding company typically runs 200,000 yen to 500,000 yen a year, every year, profit or not. An individual owner, by contrast, can often file their own rental income return, or pay a fraction of that for a simple preparer. That simplicity has real value, especially for someone with just one or two properties. Netted out, corporate tax savings minus that fixed annual cost, and the company structure still comes out roughly 1,463,284 yen ahead per year in this example, about $9,033. That gap only opens up at meaningful income levels. At modest rental profit, personal ownership is simpler and often cheaper once you account for accounting fees and the kintouwari. The crossover point most advisors point to is when your taxable rental profit consistently clears the high end of the personal bracket, well above the 8 million yen corporate threshold. There's also a brand new complication for April 1, 2026 onward, a national defense special corporate tax, an extra 4% surcharge on top of standard corporate tax. Before you panic, read the fine print. It only applies to the portion of your national corporate tax bill above 5 million yen. For a company holding 1 or 2 investment properties, your corporate tax bill almost never reaches that level, so this new tax, despite the headlines, typically changes nothing for a personal real estate holding company. Here's where this connects to our inheritance tax video. How you hold the property changes what your heirs actually inherit. Own real estate directly, and your heirs inherit the real estate itself, valued by the standard fixed asset and road price methods we covered before, a fairly rigid number with limited room to plan around. Own it through a company, and your heirs inherit company shares instead. Those shares get valued net of the corporate tax the company would theoretically owe on its unrealized gains, commonly a discount of around 37% off that built-in gain. In many cases, that produces a materially lower taxable value than the property itself. It also simplifies lifetime gifting. Transferring real estate directly triggers registration costs and real estate acquisition tax. Gifting company shares triggers neither, no registration, no acquisition tax. One more angle, specific to American investors, the choice between GK and KK isn't tax neutral for you. Under US tax rules, a GK can elect check-the-box status, filing IRS Form 8832 to be treated as a disregarded entity or partnership for US tax purposes, with its income flowing straight through to your US tax return instead of being taxed as a separate foreign corporation. A KK can't make this election. The IRS classifies it as a per se corporation, automatically taxed as a foreign corporation no matter what you prefer, which for many US investors means real double taxation exposure. This is exactly why Apple Japan, Amazon Japan, Google Japan, ExxonMobil Japan, Warner Brothers Japan, and Universal Music Japan all operate in Japan as a GK, not because they're small, but because the pass-through election only exists for that entity type. This matters most for investors with multiple properties or high net rental income, anyone already thinking about how real estate passes to heirs, and American investors specifically weighing GK against KK for reasons that have nothing to do with company size. Before incorporating, model your actual expected rental profit against both tax structures, price in the kintouwari and accounting fees every year regardless of profit, and if you're American, confirm the check-the-box election with a cross-border tax advisor before you pick GK or KK. GK versus KK is close to a non-decision on pure Japanese tax grounds. The real decision is whether to incorporate at all, and that comes down to your income level, your estate planning goals, and, if you're American, a US tax election most people never learn exists. Quick recap: KK set up 250,000 yen, GK set up 100,000 yen. Corporate tax wall at 8 million yen. Minimum annual company tax 70,000 yen even at a loss. Only GK qualifies for US check-the-box treatment. Check this against our inheritance tax and exit tax videos, the same kind of structural choice, just applied to how you hold the asset in the first place. That's the real mechanics behind GK versus KK, and why the more important question is whether to incorporate at all. Subscribe for more data-driven breakdowns of real estate and investing in Japan.
And that's today's breakdown. If you're serious about real estate or moving to Japan, research like this is exactly what separates a smart decision from an expensive mistake. Subscribe so you don't miss the next deep dive, and drop a comment if there's a city or word you want us to cover next. Thanks for watching, and I'll see you in the next one.